Hi, everyone. I'm Rick Bensignor. Today is Tuesday, September 1st, and this is the In and Out Trader Show. Well, markets are moving all over the place today. The S&P is up about 8 points as we talk. It's about 7 points off the high of the day. The big intraday change has really happened in the gold market. Gold is up about $6 right now. It was up over 20. It reached over $2,000 this morning before selling back to 1985 right now. So we continue to see lots of volatility in metals. Silver each day has typically a significant range that on even a one futures contract often approaches $5,000, if not more. So you're certainly getting some bang for your buck if you're playing that space. The US 10-year right now is at 70 basis points. The dollar index 92.07, that's down just a touch on the day. So today, in Trader Education, we're going to talk about how you are your own worst enemy. We'll do our markets overview. And then this week, I thought we'd take a look at consumer staples. It's a sector we haven't looked at for a while. And clearly, it's been a significant underperformer this year. But we are starting to see little hints of it coming back. And certainly, if the market ever did finally correct, this is a sector that we'll probably see some solid bidding to, at least during the correction phase. So I figured let's take a look at some of the popularly held names in the group. So we'll try to get through all of those. And that's that. So let's start off kind of with our trader education portion and my saying that you are your own worst enemy. And what do I mean by that? Well, it's statistically proven out that in the marketplace, any individual is typically their worst enemy themselves to their own returns. And it's why most people cannot beat a passive benchmark like the S&P. Just let's say, for example, over time, the S&P typically averages something like 7 to 8% return per year. Active money managers who are professionals, who are running funds, typically trail the S&P by 1 to 200 basis points. That's 1 to 2% or so. So even the professionals don't usually get the return of the market. And it's something along the statistics of 85% of professionals cannot match the passive return of an underlying index that they're trying to benchmark to while trying to actively manage. But here's where the real kicker comes in, and that's where individual investors trail the S&P. They are in the neighborhoods over time of trailing by over 5% a year. And there's lots of reasons why. One of them, and it's probably foremost in the equation, is that we tend to make our biggest buy and sell decisions at the worst time. Typically, we'll see if you think about how much you might have sold during the March and early April decline relative to where the market is now, and chances are you paid higher to get back in to where you sold from. And this is just proven time and time again that we are our own worst enemies, and there's fears and considerations and lots of things that get in the way of how we make rational decision making when we make these decisions, and why so often we'll watch something go against us, go against us, go against us, and finally, when you just can't take the pain anymore and you sell out of it, you're typically near the bottom. So you might feel right for a week or two that you didn't sell the absolute low, but we've all done this. I've done it. You've done it. There isn't anybody I know who hasn't sold the low to some instrument that they've been in, that they held, and just couldn't finally deal with the pain of it. And then emotions take over and they say, okay, I'm out of it. And This is kind of how we work. And the same thing, we'll watch something go higher. Your friends are telling you, oh, aren't you in stock XYZ? I bought it already. And you go for a haircut and your barber or beautician is talking about stocks and, oh yeah, I bought the stock, didn't you? And, and finally you get in, and by the time you get in, the bulk of the run is over. And then you see this instrument sell off 20 or 30%. And this, again, happens over and over again. It's why, even as a come from, I tend to be a counter trend investor and trader. I tend to buy low and sell high. And it doesn't mean that I'm always buying the lowest low or selling the highest high, but I come from the camp that fading the bigger moves in markets is often a more successful way of investing over time than simply trying to listen to what you hear on news media or some analyst on TV or somebody who upgrades a stock and chasing after things that you really kind of need to even know what the track record is of the analysts who you're following. Or if you turn on the TV and you hear on one of the business channels that stock XYZ got upgraded today, it's up 4%, that doesn't mean it's the right time to come in. There's lots of algorithms who are jumping on these headlines to get in front of all the people who then start thinking about, oh, well, maybe now is the time so-and-so upgraded stock. If a stock's been getting trashed and an analyst upgrades, it may be the time to think about it. Doesn't mean that day or that week is the time, but it may be something that if it's on your watch list, it may finally be time to start thinking about building into a position. But if an analyst upgrades a stock that they missed upgrading, in other words, let's say they were neutral on something and the stock's gone from $100 a share to $200 a share, and now they upgrade, you should know that in the scheme of things, they're often doing that because they're forced to do it because of how they get compensated and the game that they need to play as sell-side research analysts, and that they get pressure from the, let's say, director of research to say, hey, you've got a sell or a neutral on something, the stock keeps flying, we're getting phone calls about it, when are you gonna upgrade? And then they kind of often get forced into doing something because the market's forcing them to do it. And so there's lots of reasons that we get in our own way of doing things and become our worst enemy. So what I thought about is, that I am not only well versed in behavioral finance. I read lots of books, and we'll get to that in a second, but I've also taught it at NYU. I've studied the markets now for 40 years of my entire professional career. Has, let's take 35 out of the 40 years where I have intently watched and studied and looked at psychology behind decision making. And that really got prompted by all the years I was trading in the commodity pits before I even went to Morgan Stanley, and trying to understand how and why certain people who traded on the floor were so much better traders than people standing right next to them. And it often came down to, it wasn't that they were smarter, they had a better control of their emotions and proper psychology when trading. And I realized that very early in my career, and we're talking about, at this point, this was I first started trading in the pit in 1983. So I'd say by the mid to late 80s, I was already deeply into studying psychology of trading and getting my hands on not only whatever books were available back then, and there were far less then than there are now, but also really spending time analyzing traders, talking to them and trying to get the insights into what made them such successful traders. So what I've done here is I've put together a list of some of my favorite books. And this is not an exhaustive list, and it is definitely, there's no order to these. So Danny Kahneman's Thinking Fast and Slow is not my favorite book. It's just one that came to mind. So as I put this list together this morning, I was thinking about some of the books that have made the biggest impact on me. And I think that if you want to be a better trader and investor, you want to get your hands on some of these books and read them, and you will make far more money by understanding how you work, how your own brain works, trading markets, and kind of works in life too, because as I said before, it's often very similar that how you approach markets is how you approach life. And those who tend to be more risk-taking in markets tend to be more risk-taking in life. Those who tend to be more conservative in how they approach the markets also tend to be more conservative in life. So you'll get to understand a heck of a lot more about yourself and what works for you and what doesn't. And that's really important when you're trading, is to line up your trades using the same thought process that you're most comfortable with. There are times you're going to miss a great trade, and maybe you'll be unhappy that you missed a stock that you were just about to buy and it flew and you weren't in it. But I'd say you're much better off in that situation than being in a stock that you're miserable holding, that's going well against you, and you kind of are stuck because you forced yourself into it. So this list here and these are some of the kings of behavioral finance. Danny Kahneman, who was a Princeton professor now, I believe, retired. Robert Shiller from Yale. Richard Thaler from University of Chicago. Dan Ariely, Duke professor. In fact, when I taught it, I used Predictably Irrational was one of the required books for the semester in behavioral finance. And it's not hardcore behavioral finance books. There are other ones that are used more to kind of teach the step-by-step process of behavioral finance. But Predictably Irrational was, I thought, a really interesting book about how people make financial decisions and the irrationality that we often have in making these decisions. And the more you understand this, the better you will be at your own decision making. Montier's book is really good. The Little Book of Behavioral Finance. Against the Gods was probably the first book I ever read. I think this probably goes back to the 1980s. By Bernstein. That was a tremendous book about trading psychology and understanding misbehaving by Thaler, etc. So here's a list again. It is not a completely comprehensive list. There's lots more I could put on here, but I think, what do we have here? 2, 4, I don't know, roughly 10 books or something like that. You get your hands on these books, you read a few of them, and you're going to see that it will make a significant difference to how you think about the markets, how you think about life. And I can't guarantee anything in this business, but I am confident that if you take the time to learn about behavioral finance, you will do significantly better over time, and you will tend to avoid mistakes that you've done in the past, or certainly make less of them. Do I, someone who's been in the markets 40 years, still make mistakes that I kick myself in my rear end for doing? I do, but I make a heck of a lot less mistakes than I used to make, and I attribute that to experience and to learning from mistakes and to being open to understanding how my brain works, what gets in my way of getting in or getting out of a trade. And I just think I am a much better investor and certainly advisor to those of you who subscribe than I was 10 years ago, 20 years ago, and 30 years ago. And, the human being is always an evolving creature. There's never, I'm 61 years old. I don't walk around life saying I know everything there is to know about the markets. I'm constantly searching and looking for new ways and examples and just approaches to being a better investor. And I do pretty darn well, but as I say, I don't stick my nose in the air and say I know it all. I thirst for new knowledge, and I think about something that a former colleague of mine, Byron Ween, when we used to work together at Morgan Stanley, I remember him saying at his 70th birthday party that you'll take me, quote, kicking and screaming before I ever retire. And that each day I come to work looking to learn something new that I didn't know. And this was a guy who had been in the markets almost 50 years. And he would say, I want to learn something new each day. So that always stuck in my head. And I think no matter if you're 20 years old or 70 years old, you should be thinking the same. Okay, let's now move to what's next. To access my website, it's inthenowtrader.com. You will find lots of information about how to subscribe to our weekly tactical trader report, which comes out Wednesday nights. We just started, in fact, last night, I sent out the latest issue of the new monthly 7-11 report. In our first one, so this just launched August 1st. In our first month, we outperformed the S&P by just over 1%. If you annualize that, that's obviously 12%, and I don't know if we will be able to do that well, but we did outperform in the first month. That is exactly what the goal of this is to be in no more than 7 of the 11 macro spider ETFs, with the goal of avoiding the underperformers. And if we can successfully do that, we will outperform the S&P. And again, in a market that made new all-time highs and is traded straight up, it is not easy outperforming. And in our first month, we did by 101 basis points. To contact me, my email is rick@inthenowtrader.com, and keep the emails coming. Thanks very much. Love your feedback on our weekly show that we do on StockCharts, and thanks for the kind words that 99.9% of those who send feedback are positive, and I'm willing to take negative feedback too. It doesn't have to be always positive feedback. If there's something that you think we can do better, let me know. Okay, let's get on to our analysis of the markets. Let's quickly do our weekly recap before we get into looking at consumer staples. So in the past week, there are only, what do we have here? 2 of the 11 sectors did not move more than 1% better than or less than how the S&P performed last week. So week over week, 9 of the 11 sectors moved a lot. 3 outperformed, and these tend to be what have been outperformers this year: consumer discretionary, commercial services, and communication services and technology. All added at least 1% better than the S&P did last week. And you can see the underperformers tended to continue to underperform enough by at least 1%. Energy is just still the dog of all dogs. It is now trailing the S&P by over 48% this year. It's just astonishing, and that's with the price of oil coming back from single digits. Let's forget the couple hours that they traded in negative territory. That's basically coming back from $7 to the current $43, and yet this is still basically on the lowest lows of the year. So energy is just horrific. Financials, the second worst. They also lost over 1% of return last week, as even with yields having moved up, they trail the S&P. So we monitor this each week. We use the performance charts on StockCharts.com to look at one week versus the other. It's really nicely displayed in these bar charts, easy to see, and just get a sense of what's working well, what's not working well. Okay, let's go to actual charts. Here's the S&P on a daily chart. You can see late last week, you had an aggressive sequential 13 signal. Now we've had a couple other ones. Here, let me circle them. Nope, not that line. Okay, so here's the most recent one. Before that was here. So since the March low, besides the one that came in, I think it was Thursday or Friday of last week, we've had two other aggressive sequential 13s. This one was good for a quick sell-off, a couple hundred S&P points, but that was it, and the market stopped right on its cloud and turned around. This one did nothing. It stalled the market for a week going sideways before the bull market continued. So this one, you know, I don't, again, when I see multiple 13s on a daily chart not really stopping the market, I tend not to look at them nearly as closely, and I'll often want to look at a weekly chart. So let's see what the weekly chart shows. And most important is that we're on a setup 9 count this week. Doesn't mean market's going to top. This is often a pause point in a trend. Sometimes it calls more significant turns. Let me put a little more data in here and see if we go back in time. So we go back to 2018. Weekly setup 9 came with a 13 from a prior count. That got you a 3-week sell-off. This 9 basically went sideways for 4 weeks and then fell apart. This 9 did nothing. It ultimately led to all 9s are the basis to what allow counts to 13. The 13 here topped the market for looks like a full quarter. This 9 was early before this year's decline, but it is something we'll always pay attention to. So 9s and 13s are often just, you know, trigger points, places where I get less aggressive, often in the direction of the trend. So we're on all-time highs. We are making a weekly setup 9. So when you think about it too, we've moved all the way from the lows of, let's just say, 2,200 in March up to the current 3,500. And it's taken this particular most recent 9 weeks to actually put the pattern in of 9 consecutive Friday closes. That's greater than the close from 4 Fridays prior. And so this to me kind of stands out as we may be getting late in the rally. Now, I also have, let's see, I do have a monthly up here. So we'll quickly look at the monthly. And the monthly has a propulsion exhaustion signal at 35.55. And one we've just passed through, which was a full exhaustion signal, and then an older one at 35.95. So as we get deeper into this 3,500 handle, again, it's going to make me somewhat less willing to put on new longs. And if I do put on new longs, it's not going to be a name like an Amazon or an Apple or anything that's flying on all-time highs. If I'm going to put something on now, it's probably going to be more a beaten down sector, maybe a consumer staple. Maybe, I mean, energy has not paid off at all to be in an industrial name, something that still has a chance of recovery, but because it has sold off, that if the market were to come off now, it should not get hit nearly as hard as what potentially a high-flying FANG type name could sell off. Think about this: if a vaccine gets discovered, that's a viable vaccine, and I use the word viable, and when that news comes out that there is, let's say, a vaccine, it's only a matter of time before that will happen. Now, it could be in a month or it could be in 6 months or a year. But when that happens, you'll probably see an immediate shift out of the high-flying names that have done well. Like think of a Netflix. Netflix has done spectacularly well with everybody staying at home. People aren't going to the movies. They subscribe to, a Netflix. That stock, my guess is, will likely come off initially hard on the announcement of a viable vaccine, just simply because a name like that will be a source of funds for portfolio managers to sell out of in order to buy cheaper names like airlines, railroads, hotels, anything that's done poorly during this stay-at-home COVID virus time. So they're vulnerable. Names like that are vulnerable. So I'm not interested when the market's like this, getting closer to bigger targets, of going after names that are already flying. So that's my take on that. Let's get to our consumer staple names. And we'll try to get through as many as we can in the 4 minutes or so that we have left. So let's start off with Walmart. All-time highs this week. Playing with, it's slightly above, but playing with the risk level from this 13. Same type of thing here and now. I'm probably not going to chase after it, but when you look at how well this stock has done over time, and that it does build kind of consolidation areas and then move forward, there's lots of deepness to this market, so to the stock, so that even when it were to sell off, I'd probably still look to buy this on pullbacks. If we got a real good pullback down towards 121-ish, that'd be great. Otherwise, right now, the only other figure I had was about just shy of 135, which is actually where this week's low is. So this is still holding up well. I happen to own this stock for years, so I'm still holding it. But if I get up towards 164, that may entice me to take some profits. Procter & Gamble. Okay, let's see. Here we go. Okay, so this bounced on its 200-week moving average. It's also on a 9 up from last week. We're close to the upside target. Same type thing. I'm not opposed to taking a little off the table. If you want to be a buyer, buy pullback either 131-ish or down near 122. Coke, obviously not nearly as good a stock as the two we just looked at, well off its all-time highs, close to a propulsion exhaustion signal, fairly flat 200-week moving average towards the top of its recent range. I like that it doubled both lows this year. We're into propulsion bearish levels that never kicked in. So this is kind of range bound. You'd have to get this above 50 and a quarter on multiple Friday closes to get me interested. Let's take a look at Costco. Costco on all-time highs, also a weekly setup 9. We've seen plenty in the past. Some have worked, some haven't. So it's a name I'm going to kind of stay with. Unless it took out 305, I'd probably, for an investment, I stay along this as an investment. And just again, because of the 9 right here and right now, I probably wouldn't first buy it. Philip Morris. Also flat moving average, 9 high recent, 9 bottom trading range. Not something you really need to partake in. Better names out there. Mondelez, close to all-time highs, 9 up against a prior. So this dotted line here was the stop out on this 13. It traded above it, but it didn't properly trade above it, so it's still active. You got another 13 along the way. You got a 9 now. This is not a name I would buy right now. I'd rather, if you want to go after it, get it closer to $34. Let's look at Pepsi. Pepsi also approaching all-time highs, weekly 9 count last week. You're seeing some selling in here. It's also on a, no, it's only a 2 count, not a 12. That is not something I'm going to chase after right now. And let's finish up with Kraft Heinz. Clearly, here's a staple name that has not done well. You've got the bounce off in the 9. MACD is close to crossing over. If you're looking to buy this, I'd be looking near 29 3/4 as compared to here. That is it for this week. I hope you enjoyed the show. I'm Rick Bensignor, and this has been In the Know Trader.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.